Welcome to the CBS Eye on Money podcast. It is Thursday, July 1st. The second half of the year begins today. And you know what else is happening this month besides probably your vacation and a little rest? There's going to be some big money paid out starting this month. It's the child tax credit. And I recently went on CBS This Morning to talk about the child tax credit. More on that after this.
The American Rescue Plan passed by Congress in March increases the maximum child tax credit from $2,000 per child. It goes up to $3,600 for each child under 6 and $3,000 per child ages 6 to 17. The program begins paying families monthly starting July 15th. CBS News business analyst Jill Schlesinger is here to walk us through the key details. Good morning, Jill. Long time no see. Want to get straight to it. Besides the dollar amount, what's the biggest difference in terms of this year's child tax credit?
This enhanced credit is divided into two payments in half, and families that are entitled to it will be starting to get 6 monthly checks. Okay, so starts July 15th. You'll get half of that credit from July through December. And then the other half of the credit you will claim when you file taxes next year. So this is quite different because in the old tax credit, you just filed your tax return. So again, half and half starts up July 15th.
And who exactly qualifies for this new child tax credit payment?
Well, of course, it's called the child tax credit, so you've got to have a kid under the age of 17 by the end of this year. So by December 31st, you have to have had a child. Okay, but then there are income thresholds, and these are really important. If you are a single filer, you will get the credit if you have up to $75,000 of income. For head of households, $112,500. And for married filing jointly, $150,000. So those are the qualifications. I also want to make sure people understand, if you didn't file taxes, there are some Americans who don't have to file taxes. There is a tool, a portal for the IRS at the irs.gov website, and you can actually put your information in there, and that will entitle you to the credit.
Well, that sort of leads to my next question, Jill, which is what do families need to do to get this money?
The vast majority of people, birthday boy. Oh, you see how I slipped that in?
Dear.
The vast majority of people don't have to do anything. Now, this is really predicated on what has happened in the past. So if your income is about the same as it was last year, if you have the same number of kids, your address, your bank account information, you really don't need to do anything. The IRS is proactively going to take action. However, if something has changed, you do want to go over to that IRS website, irs.gov. Again, it's the Child Tax Care portal, and you want to change the information. So the reality is that if you have a sort of a similar situation, no action. If there is new information, update.
We mentioned the higher end thresholds for qualifying. On the lower end, I was reading, even if you don't make enough to pay federal income tax, you still qualify. It's totally refundable. I wanted people to know that. If the IRS says you qualify, but then your income went up over this past year, Jill, what do you do?
This is really tricky because this is unlike anything we've seen in the past. So a lot of people made lower amounts of money last year during the pandemic. Maybe your old information that the IRS has would make you qualify, but this year you might be making more money. So you are being asked by the IRS to actually opt out. This is incredibly important because you have to be proactive. So to opt out, you go to the irs.gov website, and there is a form there, and you just click through it. And the only reason you're opting out is because you think you make too much money this year to qualify for the credit. Now, I would advise that if you think you're sort of on the bubble, you're not sure whether you qualify or not, you can still opt out. And that way, next tax season, if you do qualify, you can get that full credit. But it's better not to get the money this year, because if you get it and you don't qualify, you have to pay back that money to Uncle Sam next tax season.
So, Mark, this child tax credit, it really is so confusing because, half the money getting paid out in monthly installments this year, then the other half that has to actually get claimed on next year's tax return. You know what I decided? I get why this all happened. It's just that it happened before anyone realized that the economy was really getting back on track. So what do you think people should do if they're getting this child tax credit, right? But they're really doing okay. So what should they do with this extra moolah?
Other than send it back?
No, you don't have to send it back. There's no sending it back. I mean, the only time you have to send it back is if you think you're making too much money this year. But like, what should people do, really?
Yeah, I know. That's the dilemma. That's what happened with the stimulus checks. Last year, a lot of people got stimulus checks who didn't need it.
Right.
So
And
I know.
some of them just bought meme stocks on Robinhood.
Yeah, and maybe that paid off. What do you do? I don't know. I mean, the smart thing to do would maybe just put it aside, for the child's education. That's probably what I would do.
Mm-hmm.
What do you think?
I'm thinking, after the boring stuff, my big three, right? After you've paid down your consumer loans and maybe put a little aside for your own student loan repayment, because that's starting to tick away shortly, and putting money into your retirement account. Of course, making sure you've got your 6 to 12 month emergency reserve fund established. I think that it is a great idea to use this money and to establish a 529 plan. And, we've been getting some questions about funding for college. And, I'm going to put a plug in for a website that I have no ownership in. It's just, I think, probably the best one, like the best aggregator is savingforcollege.com. And the reason why I like this is that it will tell you what your state plan is. Because don't forget, with a 529 plan, in many states, you get a state income tax benefit by using your state's plan. And I think that a lot of people they don't know that. As always, I'm very interested in finding out, in terms of what people are thinking about, whether they've been looking at 529 plans, what's the smartest one. I would never shop for a 529 plan based on performance, but I would absolutely shop for a 529 plan based on fees. And so I really would encourage you to do a little bit of digging. And again, if your state offers any sort of benefit, any sort of tax benefit, you want to use that plan. So I like that idea. If you don't need the money, maybe open a 529 plan. How's that?
I am all for that. I love the 529 plan. I love the New York 529 plan. I do get a state income tax deduction, so I am all over it. And it is all Vanguard. Very cheap.
Very cheap. So that's what we want. We want cheap, 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 cheap. Okay, before we finish up the episode today, let's do an email. You ready, Mark?
I'm ready. Let's do it.
This is from Al, who says, my wife and I have a household income of $120,000. We've got 3 children, and we plan to work for another 25 years, retiring in our late 60s. Okay, that's great. We currently have about $120,000 in our Roth IRAs, $350,000 in 401ks, and $70,000 in our checking and savings accounts. A lot of money, right? The Roths and the 401ks each have about 70% in a total stock market index fund, 30% in an intermediate bond fund. No other debt other than the house. Okay. Would you please share your view on including international stocks, international bonds, REITs, small cap value, or any other sector? And if so, what percentage should we allocate? Question 1, Mark, you like international stocks, bonds, REITs, small cap value. What do you want to put in his portfolio? He's basically pretty plain vanilla right now. Stock index, bond index.
Yeah, I like the international. Maybe if he wants to do 10 or 15% there. He says small cap, but I would just point out that he has the total stock market index that has the small cap in it. So you don't want to go out and get a separate small cap fund. You'll just be replicating things there. The REITs, if he wants to, I don't, but that's up to him. If he wants to have a little bit, maybe 5%. International bond, same thing. If he wants to, 5-10% on that side as well.
Yep, I agree. And you can sort of think of like REITs / commodities. They do act differently in different times. And so, it sounds like you like indexes, if you like a REIT index or a commodity index, and I would say a limitation of 5 for each of those. That would be my view on that. Not any other sector really from my point of view, but the whole reason to add them is because they act differently at different times. Of course, that's annoying, right? Because on some level, you're like, oh my God, the US market, it's doing everything. It's leading the way. We're the best. This is the best sector. This is the best thing to be. But, you really want to contemplate what happens under different environments and what happens when things shift. And, there have been times where international outperforms. There have been times where commodities and REITs outperform. So a little bit in both. It gives you just a little peace of mind knowing you've got some exposure to those other asset classes. Are you ready for question 2?
Ready.
Here we go. This is so perfect. Apropos of what we just talked about. Their children, Albert's children, 1, 3, and 6. They've got no money in 529s. Zero. We save 15, 16 grand a year in our tax advantage accounts. Are we right to wait until after we max out these retirement accounts before investing in 529 accounts? Mark, what's your view?
Yeah, because if they're only saving 15 to 16 grand a year in their tax advantage accounts, they're not maxing out. So I think first things first is try to max out those accounts. And once you do that, then you can start shifting some of that money into the 529s. That's what I would do.
I agree with you 100%. You know me, I like retirement first. Now, for the most important part of this question, are you ready, Mark? I want you to be prepared for this. Number 3, my favorite bourbons are Blanton's, Bulleit, Four Roses, and Woodford Reserve. Which other bourbons do you and Mark suggest? Were you not, I think the first time I saw you drink a bourbon, you drank Bulleit. Is that right?
I was a Bulleit person long before Bulleit became kind of mainstream. Now everybody knows Bulleit, but I was on the Bulleit bandwagon years ago. So yeah, I do like Bulleit, and I really, really like Woodford Reserve.
Okay, so I'm going to give you another one. I had one that I liked, and I don't buy it anymore because it got stupid expensive, but I used to buy Widow Jane, which is from upstate New York, I think.
Oh, yeah. Yeah, that's a good one.
And I liked that a lot, but then it got so expensive. My God, it was nuts. I like the Four Roses myself. I like Bulleit also, but the same thing. Bulleit has gotten so expensive, and I'm not sure exactly why. I've got one that I used to like. Someone gave me a bottle of this called Elijah Craig. That was good. And I would also be interested if you want to try to at least explore the Japanese whiskeys, which are not bourbon, but they're really, I think that, I don't know. I think that those are interesting to check out. What about last year when I sent you 6 bottles of booze in the middle of the pandemic? I was like worried because you were not drinking enough.
Yeah, I have about, I just opened up the cabinet. As we're answering this email, I opened up the cabinet. I have about 1 bottle left.
That's it? But
Yeah,
that's only, it's like a year ago.
Yeah, well, it's gone. What do you want me to tell you?
Does your partner there, she do bourbon and whiskey?
No. She's a gin fan. She loves gin.
Oh,
Yeah.
Very important to know that.
Gin and tonic is her drink.
All right. Very good. You put a little splash of the, what is that you put in there? The sweet.
Yeah, I got a Saint Germain. I have that right
Yeah,
here.
the Saint Germain. All right. Now, if you would like our input on these kinds of questions, we are very happy to weigh in. Albert finishes by saying, thank you for all of your great podcast information. Thank you for taking the time to read and maybe even respond to this multi-directional email questions. Sincerely, Albert. Thank you so much for writing. If you would like to contact us with your boozy questions, your financial questions, we're happy to respond. Just send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. If you're on our website, jillonmoney.com, you can sign up for our free weekly newsletter. So here's some other ideas, a little housekeeping here. Number 1, if you would like to make sure that you get every single episode, follow us on Apple or wherever you get your podcasts. We would also appreciate a rating and a review. And most importantly, we like to encourage you every Tuesday and Thursday when we drop this show, we want to encourage you to do something nice for someone else today. Try to lift somebody else up because it's going to make that person feel better. It's going to make you feel better. Here at Eye on Money, we've got a little mantra for 2021. Curiosity, compassion, community. We'll talk to you next week. Thanks for listening.